Starting. All attendees are in listen-only mode.
Hello and welcome to today's webinar, ACA Employer Look-Back Measurement Periods. Thank you for joining us today. Our webinar is scheduled to run approximately 50 minutes, and we will have some time at the end for questions. I'm joined by Stacy Barrow of Proskauer Rose, who will be leading us through this topic today. Stacy is an associate in the Labor and Employment Law Department and a member of the Employee Benefits, Executive Compensation, and ERISA Litigation Practice Center, as well as a member of Proskauer's Healthcare Reform Task Force. Today's webinar is being recorded, and we will post a copy of the recording as well as the slides being presented onto the Client Resource Center shortly after today's session. If you do have any questions, we ask that you enter them in the webinar dialog box, and we'll ask them to Stacy at the end of the program in the last couple minutes. At this time, I'll turn it over to Stacy to get us started for today. Stacy?
Thanks, Chris. Good afternoon, everyone. This is Stacy Barrow from Proskauer Rose in Boston. Proskauer is proud to partner with the Essential Group to offer this series of webinars to their friends and clients. Today's topic is really a deeper dive into the pay-or-play mandate. We're going to start off with reviewing the transition relief rules. We'll define our different types of employees. We'll talk about the seasonals and the variable hour employees. And then we'll move into really, how do we count hours? How do we determine full-time status? There are special rules regarding rehired employees. And we'll spend some time, of course, on the different types of measurement methods that an employer can use to identify its full-time employees. And then at the end, we'll cover some tips for dealing with changes in employment status and how that affects employees who are maybe treated as being full-time in their stability period. So the general rule with regard to the pay-or-play mandate is that it applies to what the government calls applicable large employers. Those are ALEs. We'll be using that term a lot today, and it basically is ALE status is determined by looking back over the prior calendar year and determining how many employees you had on average when you add together your full-time employees and all of the hours of your part-time employees. And together, those are full-time equivalents. And so if you have 50 or more full-time equivalents on average in 2014, then you're an applicable large employer for 2015. And you have the pay-or-play mandate, and you have the reporting obligations. There are a number of transitional relief rules that can further delay the effective date of the pay-or-play mandate. Most employers that are in the 50 to 99 full-time equivalent employee range in 2014 will be completely exempt from the pay-or-play mandate in 2015, and they'll start complying with the pay-or-play mandate in 2016, or maybe even at the start of their 2016 plan year if they have transition relief. So how do you know if you qualify for transition relief if you're in that 50 to 99 FTE range? Between these dates here, February 9th of 2014 through the end of 2014, you can have no reduction in workforce other than for bona fide business reasons like your standard layoffs or terminations. You also cannot have materially reduced or eliminated any coverage that you did have in place as of February 9th of 2014. And as long as you didn't change your plan year to begin at a later date after February 9th of 2014, your transition relief will continue all the way through the 2015 plan year until the first day of the 2016 plan year, if you have a non-calendar year plan. Now, even though you may be exempt from the pay-or-play mandate in 2015, you still have the Section 6056 reporting requirements, which apply to all employers that have 50 or more full-time equivalent employees on average in the prior calendar year. And in fact, if you're in that 50 to 99 range, you will certify to the IRS that you qualify for that transition relief as part of your Section 6056 reporting. So again, if you're in that 50 to 99 range, one of the things we mentioned here in the second to last bullet is that you cannot have materially reduced or eliminated coverage in place as of February 9th of 2014. And these are the three criteria for ensuring that you have not materially reduced or eliminated benefits. You basically have to maintain your employer contribution towards single coverage as described here. Any changes to single coverage must continue. The plan must continue to provide minimum value after any change, and the employer cannot narrow eligibility requirements in place on February 9th of 2014. So, for example, if you qualify for the transition relief for 50 to 99 FTEs, but you have, say, eliminated spousal coverage in 2015, then you're going to lose your transition relief. And again, as I mentioned, it applies for the entire 2015 plan year as long as you haven't changed the plan year after February 9th, 2014 to begin at a later date. So that's the relief for the 50 to 99 groups. As you also likely know, if you are a large employer with 100 or more FTEs in the prior calendar year, you're generally subject to the pay or play mandate this year in 2014. However, you have transition relief that's available if you meet these requirements. And they're a little stricter than the ones we just talked about for the 50 to 99 groups. And again, this is just for those with 100 or more FTEs on average in 2014. So first requirement is the non-calendar year plan had to have been in place on December 27th of 2012, and the plan year cannot have changed to a later start date after that time, after December of 2012. And you must offer affordable minimum value coverage on the first day of the 2015 plan year to all of your full-time employees. Otherwise, if you don't, then anyone who's not offered affordable minimum value coverage can trigger a penalty going back to the start of 2015. Generally, it'll be the $3,000 penalty. So if you meet these basic requirements, then you can look to see if you meet one of the 4 significant percentage of tests. And there are 2 ways to do this test. You can look at all of your employees, or you could just focus in on full-time employees. In either case, the numbers change a little bit, but the general rule is you have to have offered coverage to at least a third of all employees or had 1/4 of all employees enrolled at the end of the most recent open enrollment ending prior to February 9th of 2014. So they do want you to go look back a little bit to make these determinations. And then if you can't satisfy this test based on all employees, you can perform it just looking at full-time employees, and the numbers increase to 1/3 covered or 1/2 offered coverage. That's the transition relief for non-calendar year plans. So just to spin through the 2 penalties really quickly before we get into the nuts and bolts here, there are generally 2 penalty regimes under the pay or play mandate. There's the A penalty and the B penalty. And the A penalty applies if the employer fails to offer coverage to at least 95% of its full-time employees and their dependent children. You have a little transition relief in the first year. You only have to offer to 70% to get outside of the A penalty. But of course, any employees who are not offered coverage could then trigger the $3,000 penalty, which is the B penalty. We'll talk about that on the next slide. So here, if you haven't offered coverage to at least 95% of full-time employees, 70% this year, and you have at least one full-time employee who goes out and gets subsidized coverage on the exchange, then the penalty here is $2,000 multiplied by every full-time employee in the company, even those to whom you offer coverage, minus the first 30 full-time employees. That reduction is 80 in 2015, but only for employers with 100 or more full-time equivalents. If you're subject to pay or play in 2015 and you're in that 50 to 99 employee range because you don't qualify for transition relief, then your reduction under the A penalty is only 30 employees. The penalties themselves are assessed monthly, and they are on a per EIN basis, in other words, a per tax ID basis. So if you have, say, 4 related companies, each of them has 25 employees, 25 full-timers, you have 100 in total. You're subject to the mandate this year, but each entity's compliance is assessed separately. So if you had companies A, B, C, and D, and companies A, B, and C offered affordable coverage, company D was the only outlier, then company D would be subject to the A penalty or the B penalty as applicable, and they would not taint the compliance of the other members of the controlled group. So all the penalties are on a per tax ID basis. So this is the penalty that I think is of more concern to those of us on the call today, and that is the unaffordability penalty, otherwise known as the B penalty. So here is generally where the employer offers coverage to its full-time employees, but for some employees it's not, quote, affordable because the cost exceeds the permitted amount. And I'll get into the cost in a second. But if you do offer coverage that's not affordable or that does not meet the minimum value standard, and you have at least one full-time employee who goes out and gets subsidized coverage on the exchange, the penalty is $3,000 for every full-time employee, but only those who actually go out on the exchange and get subsidized coverage. And so, in a way, the $3,000 penalty should always be less than the $2,000 penalty, because the $2,000 penalty applies to all of the full-time employees, minus 30 or minus 80 this year if you have over 100 FTEs. Now, one question we often get is, well, what happens if many of the full-time employees who are offered unaffordable coverage go out and get a subsidy? And, say they all go out and get a subsidy. In that case, the $3,000 penalty could potentially be more than the $2,000 penalty. However, the $3,000 penalty is always capped at what the $2,000 penalty would have been had it applied. In other words, you'll never be penalized more for offering unaffordable coverage than having offered no coverage at all. So how do we know if coverage is affordable? If the cost to the employee of single coverage that provides minimum value does not exceed 9.5% of his W-2 wages or his rate of pay multiplied by 130 hours per month, or the federal poverty level, then the employer is offering affordable coverage under a safe harbor. The true test of affordability is based on household income, and that metric changes every year. It increases from 9.5%, and so for 2015, employer-sponsored coverage is affordable to an employee as long as it does not exceed 9.56% of his household income. But all of the safe harbors are still hard-coded at that 9.5%, and so at this time it's generally just recommended to think of that as, that's your number, the 9.5%. Make sure employee contributions don't exceed 9.5% of wages, and you should be in good shape. And you can also use the the rate of pay safe harbor as well, another very useful safe harbor and I can talk about that at the end if folks have questions. Just a note about wellness programs and affordability. Employers are allowed to treat all employees as being non-smokers for affordability purposes. So, for example, if you offer coverage to employees that cost $100 a month, but if they're smokers and they're not in your smoking cessation program, you're going to charge them $150 a month, you can always treat them as having been offered coverage for $100 per month for affordability purposes, even if some of those employees are smokers and they pay the increased rate. So in other words, you can always treat employees as being non-smokers for affordability purposes. Now, any other wellness program, you must assume that the employees do not participate and do not obtain the reward. Okay. So, as we know from the pay-or-play mandate, the basic requirement is we have to offer coverage to full-time employees. And we don't have to offer coverage to part-time employees or seasonal employees or variable hour employees unless and until they become full-time employees. So let's talk about some of those terms, and we'll flesh them out a little bit. So what's a full-time employee? Full-time employee status generally determined at the date of hire, and an employee who is reasonably expected to work an average of at least 30 hours of service per week is going to be a full-time employee. The monthly equivalent of 30 hours per week is 130 hours of service per month, and so you can consider any employee who hits 130 hours in a month as being full-time. But what if an employee is expected to work less than 30 hours per week during his initial measurement period? Those employees are part-time, and they won't be required to be treated as full-time or required to be offered coverage as long as they do, in fact, average fewer than 30 hours of service per week during their initial measurement period or during a standard measurement period, which we'll talk all about in a few minutes. So this is a concept that you've probably heard a lot about, at least in name, and that is the variable hour employee. The determination of whether an employee is variable hour or part-time or seasonal, full-time, is generally made at the time of hire. And a new employee is able to be treated as variable hour only if the employer cannot determine if the employee is reasonably expected to work at least 30 hours per week during the initial measurement period because the employee's hours are variable or otherwise uncertain. So you can measure them over this period of time. It's between 3 to 12 months. Most of the time, employers are going to use 12 months. We'll talk about that in a little bit. But you can measure their hours over a period of time to determine full-time status, which provides employers and employees and the exchanges a little bit of stability, so you're not measuring employees on a month-to-month basis and taking them on and off the plan on a month-to-month basis. So another question we get very frequently is treatment for temps, temporary employees. You know, the client will say, you know, we hire these folks for a couple of months, for 2 months, or 4 months, or 5 months, or 8 months, whatever it is. They're temporary, and so, you know, how do we treat them? And the bottom line is that there are no blanket exclusions for temporary employees. They're either going to be full-time or part-time or variable hour or seasonal. And when you're making this determination, both for variable hour employees and for part-timers, you can't take into account the likelihood that an employee may terminate employment before the end of the initial measurement period. So if you have a project and you're going to hire employees for 8 months and then terminate them, and you say, well, I know they're not going to average 30 hours over 12 months because I'm going to terminate them after 8 months, you cannot take that into account when determining whether they're variable hour. And so, in other words, if you hire temporary employees to work 30 hours or more per week for 8 months, they're full-time employees, at least for the time that they are employed by you. Now, for truly short-term employees, there is an exception. And if the employee does not remain employed beyond the end of the 3rd full calendar month of employment, then they will not be treated as a full-time employee and will not be able to trigger a penalty. So, employees you hire for 2 or 3 months, they are generally never going to be considered full-time employees, even if they work full-time during those few months that they're with you. But once you get beyond the last day of the 3rd full calendar month of employment, if an employee is in fact full-time, then you need to start offering coverage. Otherwise, you could be exposed to potential penalties. So what about seasonal employees? There's a lot of confusion here, mostly because the regulations have 2 different definitions of seasonal employees for different purposes. One definition, they apply a 6-month limit, and then another purpose, they apply a 4-month limit. And I'll talk about that in a minute. But the general rule that we should all be concerned with for seasonal employees is a 6-month limit. And so if an employee is hired into a position for which the customary annual employment is 6 months or less, and by customary we mean that the position typically exists for 6 months or less, and it starts at around the same time each year. It could be summer, could be winter, could be tax season or football season or hockey season. It doesn't necessarily have to be temperature related, but the position does have to typically start around the same time each year. And so the way the rules work is that if you truly have a seasonal employee, then you are allowed to treat him as variable hour, and you can measure the seasonal employee's hours over a 12-month period. And so basically, no matter how many hours he works during that 6-month period, he'll never average 30 hours a month over a 12-month period. And even if he does, if he's only hired during the season, then he'll have a break in service of at least 13 weeks. And when he comes back, he'll be able to be treated as a new employee again. And so you have kind of a 2-pronged defense there against seasonals being treated as full-time. And so the end result is that most seasonal employees will not have to be treated as full-time. There is this kind of a special rule down at the bottom. And basically, when you're determining if you're a large employer, and the only reason that you're a large employer is because of your seasonal employees, meaning you only exceed that 50 FTE threshold because of your seasonals, and the seasonals only work at most 4 months or 120 days, and the employer doesn't exceed 50 employees for more than 4 months or 120 days, then you can exclude your seasonals from the count, and you won't be an applicable large employer. But again, this is a very granular rule, and it really doesn't apply to the vast majority of employers. So those are our definitions of the types of employees. Now, how do we know if someone is our employee or if he might be the employee of another entity? The IRS generally uses a 20-factor test for these purposes. They look to see which entity, whether it's the leasing company or the staffing agency, who has the right to direct and control the employee. Is the employee subject to the will and control of the worksite employer, or is he really under the control of the staffing agency, the leasing company? This is a very fact-sensitive test, and we strongly recommend that if an employer has questions regarding its employees' common law status, that they talk directly with counsel so that all facts can be considered. These are the 20 factors that the IRS will consider. And again, none of them are dispositive by themselves. You have to always look at the facts and circumstances, and what might be decisive for one company may not really win the day for another company. So you really need to look very closely at the facts when making these determinations. So what do you do about staffing companies, so staffing company employees? In general, the employer, the worksite employer, the guy that hires or receives employees from the staffing company, they are typically not the common law employer of the staffing company employees. Most of the time, the way it's set up is that the staffing company is the employer of its staffing company employees. But, like we say in this first bullet, the employer can be considered the common law employer. In the event the employer is the common law employer of the staffing company's employees, then the employer can receive credit for the offer of coverage made by the staffing firm, but the employer then has to pay a higher fee to the staffing company for any of those staffing company employees who enroll in the staffing company's plan. Again, this additional fee only applies if the employer is the common law employer of the staffing company's employees, and that's just typically not the case. And again, it does require a very close look at the facts and circumstances, and we know under the mandate that PEOs, professional employment organizations, they are not the common law employer for ACA purposes. The pay-or-play penalties all apply at the member company level, the worksite employer level. Okay, so how can we use the rules that we just talked about to maybe limit our exposure here? And since we've talked a lot about working 30 hours per week or 130 hours per month, it makes sense to define what is an hour of service. It's any time for which the employee is paid or entitled to pay. So any time that he works, plus any paid vacation or paid holiday time, paid sick time, and certain unpaid leaves like unpaid FMLA, USERRA, or jury duty also count as hours of service. Generally, your employees that work outside of the U.S., if they're not paid from U.S. payroll, then their hours are typically going to be disregarded. Most employers will track hours of their employees based on their actual hours worked or hours paid, but if you don't do this, then you're generally required to use one of the equivalency methods listed below on this slide. Another question that we get very frequently is, how do we treat employees who leave and come back, the rehired employees? And the general rule is that if an employee has a break in service of at least 13 consecutive weeks during which he has 0 hours of service for that employer, he can be treated as a new employee upon return and made to satisfy the waiting period or the initial measurement period, whatever applies to the employee in that category. So most employers use 13 weeks. Educational institutions get to use 26 weeks. I shouldn't say they get to use, they have to use 26 weeks. And so it makes it less likely that they will be able to treat a returning employee as a new hire because they require a 26-week break to treat that employee as a new hire. There is a rule of parity, and the way it works is that you can treat a returning employee as a new employee even if his break in service is not 13 weeks, but it's at least 4 weeks, and it's less than 13 weeks, and it's longer than the employee's prior period of employment. So, for example, if an employee comes and works for you for 2 months, for 8 weeks, and then he leaves for 10 weeks, he can be treated as a new employee because his break of 10 weeks was longer than his prior period of employment, and that's the rule of parity there. I mentioned this one, special unpaid leave also counts as hours of service. You can either disregard it from the denominator, or you can take an average of the employee's hours during the measurement period and substitute that average during periods of special unpaid leave. Either way, those two methodologies should produce the exact same result. Okay. So moving in now to the measurement periods, there's basically two ways to determine full-time status of an employee. You can look at employees on a month-to-month basis. If they're full-time in that month, great, they're offered coverage in that month. If they're not full-time in that month, then you don't have to offer the coverage, and coverage could be terminated and the employee could be put on COBRA. Now, this appears to be fairly administratively burdensome for hourly employees whose hours may shift from time to time or may fluctuate. Your salaried employees, you typically are going to use the monthly method. We tend not to run into employers that have part-time salaried employees or employees that are salaried, but they move from full-time to part-time. This doesn't typically happen that way. And so most employers, for their salaried employees, will simply treat them as full-time and offer them coverage. That's the monthly method. Most employers that have hourly employees that are not clearly delineated as either full-time or part-time may use a look-back method to determine which of those employees average at least 30 hours per week. And again, if you don't have any employees who hover around that 30-hour threshold, you may just want to consider continuing on as usual, and you'll know that you'll treat all your employees who regularly are scheduled to work 30 hours as full-time, and then others that are under 30, you'll just kind of make sure you keep them under 30 hours per week. If not, then you can use the look-back measurement method. And this allows you to select a period of time from 3 to 12 months, and we'll talk a little bit about why the 12-month is probably the way to go. And the employee will be treated as either full-time or not full-time following the look-back period, regardless of his hours worked after the look-back period, and that is called the stability period. So in other words, if you work full-time for your employer for an entire year, then you're generally going to be treated as full-time for the subsequent calendar, or subsequent year, plan year typically. Alternatively, you can do this on a monthly basis, but let's take a look at how these work, and I'll give you a visual representation of these rules, which I think helps clear it up a little bit. So you'll see here that I've boxed one of the 4 permissible categories, and that's the one for salaried employees and hourly employees. So generally, if you're going to use these measurement and stability periods, you must do so consistently for all employees in the same category. And so in other words, like I said, most employers are going to use the monthly method for salaried employees, and they'll use the look-back method for all hourly employees. Even the full-time employees will be swept into the standard look-back period and standard stability period. Of course, new full-time employees don't have an initial measurement period. They're just basically required to be offered coverage by the end of the waiting period, so typically within 90 days of date of hire. So here, I have an illustration of how the look-back and stability periods work when you have a 3-month look-back period. And I didn't mention it on the prior slide. I stated that the minimum length of the stability period for a full-time employee must be at least 6 months. And so here, as you can see, it really doesn't do you any favors to use a shorter measurement period because they basically run back to back to back, and so you'll just be doing this 3 or 4 times a year. This is an example of a 6-month look-back period, and you can see it gets a little less crowded because we're only looking back twice a year. And then finally, we have the 12-month look-back, which really is pretty simple. This is an example of a calendar year plan. The stability period runs for the calendar year. There's a 2-month administrative period during which the employer will do the math, figure out who worked full-time, and give them enrollment forms. And then the 12 months ending prior to the admin period is the look-back period, and that's the period during which you're going to measure employees to see if they work full-time. Now, you're only going to measure folks under this measurement method that have worked for you for the entire look-back period. So if we look at the bottom example here, the 12-month look-back period, say we had a guy who's hired in June of 2014. You obviously cannot measure him under the period that started in November of 2013 because it wasn't working for you yet, but he will start his standard look-back period in November of 2015. But what do we do since he was hired mid-year? So this is an example of a 12-month initial measurement period for Emma and Barry, who are both variable hour employees. Emma starts on May 15th, and Barry's first day of work is September 1st of 2014. So with Emma, her first day of work is April 15th. We're going to start her initial look back as of May 1st. It's going to run 12 months through April 30th. She'll have a 1-month administrative period during the month of May, and then her initial stability period will run from June of 2015 through May of 2016. Now, what you see here, though, is that Emma, by the time she is finished with her initial stability period, she will have worked for her employer for the entire look-back period that ran from November 1st of 2014 through October 31st of 2015. And so while she's riding out that stability period, that initial stability period, she will roll on to the standard look-back and standard stability period up above in blue. And so as long as she works full-time during the initial measurement period and the standard measurement period, she'll have no gap in coverage. Similar situation for Barry. He starts September 1. That's going to be the start date of his initial look-back period. And he also has a 12-month initial measurement period and a 12-month initial stability period. Both Emma and Barry begin their first standard look-back period on November 1st of 2014 because that's the first one that starts when after they've been employed. And so when each of their initial stability periods run out, they'll take under the standard stability period, and if they worked full-time during both the initial and the standard measurement period, they'll have coverage through the end of 2016 in this example. I know that's a lot to swallow, but hopefully if you spend some time looking at those slides after the presentation, you'll get a good understanding of the measurement and stability periods. So the next few slides before I open it up to questions deal with employees who changed employment status. And they might move from one type of measurement method to another type of measurement method. So, again, as I mentioned, employers are probably going to use the monthly method for the salaried employees and the look-back method for the hourly employees. And so under the monthly method, it's kind of just like it is now. If you have an employee reduce hours to under 30, you can generally terminate coverage and offer COBRA. But it works a little differently under the look-back method. And again, if you measured an employee for 12 months and he averaged 30 hours or more, you're going to treat him as full-time during the subsequent stability period, even if his hours reduce to under 30. As long as the employee continues to remain employed, you're going to treat him as full-time for the remainder of that stability period. Now, it's worth noting that, if an employee comes to you and asks to reduce hours below 30 after he is measured as full-time, that's up to you as the employer. You don't necessarily have to let employees back their hours down and maintain their coverage. You could simply say, look, this is a full-time position. We need you here full-time, and if not, then we may need to terminate you. So just something to keep in mind there. So what if you have a change in employment status during the initial measurement period? So the general rule is that when an employee makes a change before the end of a stability period, it's generally not going to change his or her treatment as a full-time employee or as not a full-time employee. However, there is an exception there. When you have a new hire, new employee, you're treating him as variable hour, but he gets promoted during the year, then you generally need to treat him as full-time by the earlier of the start of the initial stability period or the first day of the fourth full calendar month following the change. So this probably won't happen all that often, but say you hire a variable hour employee, he's working for you for a few months, everything's going great. You say, look, we're going to promote you to a full-time position. Then you just basically put him on the plan after the waiting period in no event later than the first day of the fourth full calendar month following the change, and then you won't have penalty exposure. So what about changes in employment status that will change the determination method, for example, going from the look-back method to the monthly method, like an employee changing from an hourly position to a salary position? And again, they're probably using the monthly method for the salaried folks and the look-back method for the hourly employees. So when an employee makes that change, if he's full-time, then you just continue treating him as full-time for the remainder of the stability period, or if he's not full-time, you can either continue treating him as not full-time for the remainder of the stability period, or you can change over to the monthly measurement method, which would result in the employee ending up being treated as full-time. And then once that stability period ends, you just continue to evaluate him under the monthly method going forward. What is a little more likely is you have an employee that maybe is changing from the monthly method to the look-back method. You might be going from a salary position to an hourly position. And here, if the employee's hours prior to the change, when he was working full-time, would have resulted in him being treated as full-time during the stability period, then you basically do need to treat that employee as full-time for the remainder of the stability period. Otherwise, you'd use the monthly method for the remainder of the stability period. Now, if an employee makes this request near the end of the measurement period, he might be treated as full-time not only for the remainder of the current stability period, but for the whole next year as well, because he's changed to part-time, say in month 11 of his measurement period. So how is employers supposed to deal with possible abuse in these situations where you have an employee that kind of games the system a little bit and you request to change to part-time just after being deemed full-time due to working 30 hours over a measurement period. And so there's a special rule that provides some really nice relief in these situations. So here, there's this special rule for employees who have been continuously offered minimum value coverage at least by the end of the third full calendar month of employment. So this is really only useful for employees who do not have an initial measurement period imposed, typically your full-time salaried or your full-time hourly folks. Here, the way this rule works is that if you have a regular full-time employee who makes a switch to part-time, the permanent drop to part-time status, then you can use the monthly method after the end of the third full month following the change. And so the bottom line here is that when an employee moves from full-time to part-time, as long as he's been continuously offered minimum value coverage since the end of, or by the end of his third full month of employment, then you can drop him from coverage at the end of the third month following the change. So you really only need to carry employees in these situations for a few months following their change to part-time status, and then you can use the monthly measurement method for them through the end of the first full measurement period that applies after the change in status, even if you usually don't use the monthly method for other employees in that category. This is an exception to that rule. I know this one is tricky, but it really does provide some good relief to employers that have employees who change to part-time status. So this might be a good one to spend a few minutes on at your leisure. Just want to remind folks, you can always get up-to-date information via signing up for our ERISA Practice Center blog, and you can also check out the latest edition of our healthcare reform book. This is a Q&A guide. It's several hundred pages, very fulsome guide to healthcare reform. With that, that is the end of my prepared slides. I'm happy to open it up now to questions if any have come in.
Great. Thank you very much, Stacy. And just as a reminder, if you do have any questions, we'll be going through them now, so feel free to enter them in the questions dialog box. And just to answer a couple of them right off the bat, we will be posting this recording as well as the slides to the Client Resource Center shortly after today's session, and you could also reach out to the person that referred you to this session as well. So the first question here, for the 50 to 99 FTE transition relief, how does the maintenance of coverage required apply if the employer offers more than one plan option and subsidizes the plan options at different levels?
It would apply separately to each of those plan options. You have to maintain the contribution as required by, based on each of those options.
Okay, and the next question, how is FTE defined?
FTE, we use it to collapse the full-time employees and full-time equivalents. So, full-time employees, one person that works 30 hours or more. Full-time equivalent might be two employees who work 15 hours per week. And so it's the combination of full-time employees plus the hours of the part-time employees. Together, they are full-time equivalents.
Okay, this next person asks, what about interns? They may work full-time during the summer, but won't continue during the school year.
Yeah, let me just go back to the slide. There's no special rule for interns. They're generally going to be in this category as temp employees. If they're only with you for a couple of months, 3 months during the summer, then maybe this last bullet here will apply. You won't have to treat them as full-time, but if they're there for some reason they're working, for 4 months, then after the end of the third full calendar month of employment, they're basically going to be treated as full-time, and it can start triggering penalties. If they're part of a state or federal work-study program, then you can disregard their hours.
All right. Regarding hours of service, if an employee is out on disability and is receiving disability benefits either from a self-funded plan or from an insurance carrier, is the employee credited with hours of service while on disability?
Yeah, any time that the employee is paid or entitled to pay, so paid sick leave, paid disability, would all count towards hours of service. Typically, I think this is mainly short-term disability. Once an employee becomes entitled to long-term disability benefits, he's typically terminated and no longer considered an employee.
Can you reiterate what needs to happen when you have salaried and hourly employees? Can you use the monthly measurement period for the salaried employees and the look-back measurement period for the hourly employees? This was not clear to this person on slide 23.
Yeah, they have it right. I mean, the way that they have articulated it is correct. You know, you typically are going to use the monthly method for the salaried folks and the hourly method, the look-back method for the hourly folks. And based on, let me go back to the slide, pardon me, right here, you're allowed to use the, I don't know if I'm sharing anymore, but you're allowed to have different categories or different measurement stability periods for salary versus hourly employees. So you got to treat all the hourly folks the same, but you can carve out the salaried folks and they can use the monthly measurement method.
Okay, if an employer has permanent part-time employees working the same hours every month and also has variable hour employees, must the employee still test the part-time employees?
Yeah, because if you're using the look-back measurement method, you have to test all hourly employees together. So your permanent part-timers, you know, I mean, you're testing them, but they're never going to average 30 hours. So, you know, it's really kind of a name only, but you really don't have anything to worry about. If they're permanently part-time, they should never average 30 hours over any look-back period, so they shouldn't ever be treated as full-time.
Okay, this next question is, we hire many part-time employees at the start of our busy season, knowing that over the entire 12-month measurement period, they will average below 30 hours per week and are therefore defined as part-time. Yet at the start of our busy time, they may work more than 30 hours, even 40 hours per week from time to time. But as the business slows, they will work 20 or less hours a week, and over the 12-month measurement period, they remain under 30 hours. Do we run into any trouble if they start out working well above 30 hours, as long as the average over time remains under 30?
No, that's fine. I mean, that's basically the definition of variable hour employee. Some weeks they're expected to be over 30, and some weeks they're expected to be under 30, such that you really don't know if they're going to hit that average over the course of the initial measurement period, and that's why you need to measure them for 12 months. And so there are examples and there's guidance saying, you know, look, it's certainly possible that an employee might start out working full-time, but you fully expect them, based on the facts and circumstances, to have reduced hours later in the measurement period. Now, the only thing you can't do is you can't take into account the likelihood the employee is going to terminate, but if you know that they're going to work 40 hours for 4 months and then 22 hours for the remainder of the year, then, you know, those are variable hour employees because it's not clear that they're going to hit the 30-hour average.
Okay, do employers have to offer affordable coverage to dependents?
No. No. You do not have to make any type of contribution toward dependent coverage. You're allowed to if you want, but you could have employees buy up completely for spouse and dependent coverage, and as long as you're offering dependent child coverage and the cost of single coverage to the employee is affordable, then you're in good shape from an affordability standpoint.
All right. What if an employee is reasonably expected to work less than 30 hours, but then ends up averaging more than 30? Is it okay to use the 12-month look-back period and change those people to full-time and offer coverage at the end of the measurement period?
Yeah, that's kind of what these initial measurement periods are used for. You've hired someone, at the date of hire, based on all the facts and circumstances that are available to you. You made a reasonable determination that it wasn't clear to you whether the employee is going to average 30 hours, and so maybe he, started working out 25 hours. Now he's working 40 hours every week. You still get to wait those 12 months to measure him, except for that special rule that I talked about here where you're really promoting someone to full-time status. Then you do need to offer them coverage a little earlier than normal. But if it's just an employee who happens to be working more hours, you can still continue him through the initial measurement period.
All right. When considering wage, are cost of benefits included or just straight rate of pay?
Well, there are several safe harbors. Going back to them again. The W-2 safe harbor is based off of Box 1 W-2 wages, so it is net ultimately of 401k contributions. The rate of pay safe harbor, I really like that one. I think it's very useful for employers. It allows you to make a prospective determination of affordability rather than having to wait until the end of the year and hope that coverage is affordable based on the W-2, which we really don't know for sure until the end of the year. The rate of pay safe harbor lets the employer assume the employee works 130 hours per month, multiplies that by their hourly rate of pay, and as long as the contribution is not more than 9.5% of that amount, then coverage is affordable under the rate of pay safe harbor. So if you have hourly employees that really hover around 130 hours per month and you think they might dip down during the stability period, I think it's very useful to explore using the rate of pay safe harbor because you always get to use 130 hours. The only time I think the W-2 safe harbor might be better is that if your hourly employees are all working like 40 hours a week or 160 hours a month, then you'll get more of an employee contribution by using the W-2 safe harbor than you would by using the rate of pay safe harbor, because rate of pay always uses 130 hour per month standard. Hopefully that answered your question.
All right. The person asking this question is just looking for some clarity. If a salary person goes to part-time, we would offer COBRA. If a salary person goes to variable hour, they would stay on the plan through the stability period. Is that correct?
No, not exactly. I mean, you should take a close look at, get to it, at this slide. Again, the concept of variable hour only exists for new employees. If you have an employee who's moving salary to part-time, and it's part-time hourly, then they are going to have stability period protection. Same thing if they move the variable hour status. I guess the only difference is that if they truly make a permanent change to part-time, you can use that 3-month rule to cut them off from coverage, whereas you may not have that ability if they're moving to a position where their hours will vary above and below 30. That will not qualify you under this special rule here. So, I mean, the answers are often very fact-specific, so I would invite you to take a close look at these slides, and hopefully it'll be clear after that.
Okay, if we offer... Sorry, go ahead, Stacy.
I can take one more, and then I'm going to jump onto another call.
Sure. If we offer one plan option that is fully covered and all full-time employees and another that is that they must pay the difference on, is our plan considered affordable?
Yeah. All you have to do is offer one benefit option that's affordable, and if there are multiple options and some of them are not affordable, as long as one of them is, then you've met your affordability requirement. It has to be affordable and minimum value, but as long as at least one option meets both of those criteria, then you're in good shape.
All right, great. Thank you very much, Stacy, and thank you everyone for joining us. We hope you can join us for our next next webinar. It's posted on the Client Resource Center, so hopefully you can join us for that. Have a great day, everyone.
Thanks, Chris. Have a great day, folks.